Well, thank you, everybody. It's 6 o'clock, and we are so glad that you're here with us tonight. Welcome to the LAFCU Home Buying Webinar. And I'm Kelly Swiger, the Creative Director at LAFCU, and I'm here just to walk you through a few housekeeping rules to kick off our event tonight. We would love for you to turn your videos on if you can. It makes it more fun and engaging for all of us, but totally up to you. We're excited to have Rob Boomershine here of LAFCU, Zach Carlson, and Rob Kennedy of Member First Mortgage, who will be presenting tonight. If you have any questions during the event, you can either use the chat box or you can wait until the end of the presentation, and we would be happy to take any questions that you may have. We will also be recording tonight's event. So without further ado, please help me give a warm welcome to Rob Boomershine of LAFCU. Hi, Rob.
Hi, Kelly. Thank you so much. Thank you all so much for taking the time to connect with us tonight. We really appreciate having you here. My name is Rob Boomershine. Like Kelly said, I'm the VP of Lending here at LAFCU, and primarily I spend my time working with the mortgage process here at LAFCU, which means that I get to spend some good quality time with these fine gentlemen that you guys are going to be hearing from very shortly here. Before we jump into the presentation, I wanted to give a little bit of history on how we got to this point that we're at today. About 20 years ago, LAFCU decided to invest in a QSO named Member First Mortgage, also known as MFM. This investment has paid incredible dividends over the last 20 years, and it's also allowed LAFCU the opportunity to increase service and the technology that we get to offer to our members, which has been really exciting. Because of our ownership in MFM, we have at our fingertips the resources to originate, process, underwrite, and close a multitude of different mortgage products. It's also incredibly beneficial to have the ability to meet and exceed service standards, turnaround times, and compliance requirements in the course of processing those mortgage applications. So as we move forward and I introduce you to Rob and Zach, I want you to understand that we all exist as one team to serve your needs. There is no us and them. There is no LAFCU and MFM. MFM is our mortgage department, and we're here to serve your needs, and we're very excited to do so. Rob and Zach both have worked for credit unions throughout the state of Michigan. When choosing Rob and Zach as our mortgage loan officers, this was an important factor that we wanted to make sure that they understood LAFCU's service culture, and also that they understood the credit union philosophy of people helping people. Rob has been in the mortgage industry for 5 years and Zach for 8 years. When asked why they chose this as a career option, without hesitation, both of them were able to offer stories of how they've been able to create positive impact in their members' lives as they've helped them with their mortgage needs. I'm proud to introduce you now to Zach Carlson and Rob Kennedy.
Hi, everyone. Nice to meet you. Look forward to talking with you guys here.
Yeah, the same. I'm absolutely thrilled to be here. This is a great opportunity to get to know everybody in the community. So we're looking forward to a great webinar today. So today, what to expect that you'll walk away from, that you'll get out of this is what's going on our agenda. First, we're gonna cover what it takes to qualify for a mortgage loan. Then we'll go through the different mortgage programs that we offer, the difference in a pre-qualification and a pre-approval, and we'll cover the do's and don'ts of the buying process so that when you leave here, you'll feel more confident going into the process. And we'll end with some questions and answers, and I'll let Zach take it away.
Yeah, so of course, first part we're going to want to start with is what are the general steps of buying a home and kind of where we would start on this. So the first thing you're going to want to do is select your team. Now your team's going to be your agent, a realtor. Your team's going to be the loan officer, right? Myself or Rob. And also, your team is going to be the credit union. So LAFCU is going to be an important part of this process going forward. So one of the first things after you select your team, you want to make sure that when you do select your team, that you're selecting people, a realtor that's going to be communicative, that's going to be involved, that's going to communicate with not only myself, but also the credit union, and make sure that they got your best interest in need, or best interest in mind. Next step would be determining your housing need. Are you looking for a 3-bedroom, 2-bathroom, or do you have, 5 kids and you need a 5-bedroom or 6-bedroom even? Do you own 13 vehicles and you need a large garage and parking area? So you're going to kind of want an idea of what you're looking for, because that's going to give us some ideas of how to gear that loan towards you. Another part of selecting your team is making sure that, like we talked about, is the consultative approach. And what that means is that everyone's working in conjunction to make the loan work for you. One of the biggest things with LAFCU and that approach is that, we can determine if, let's say we run into an issue with your debt to income ratio, which we'll get into later. We can talk to the credit union about refinancing a vehicle or consolidating debt or whatever it may be to make that loan work. That's going to be the huge benefit of working with the credit union and with MFM. So once you've selected your team, determined your housing need, the next thing you're going to want to do is make an offer. And that's going to come after you've already gotten your pre-qualification or pre-approval, but you're going to make an offer on a home. And that's going to involve, your realtor, the lender, LAFCU. So you're going to need all those things to come together. Right now, we're in a very, very competitive housing market. So you're seeing multiple offers on houses. You're seeing a lot of interest in the same houses, and you're seeing sales prices go higher and higher, right? So by having everything ready to go up front, that's really going to make a difference in your process going forward and making an offer and getting your offer accepted, which is more important than making the offer, right? So those are kind of the general steps, and we'll get into them in more detail, but those are kind of the general steps in buying a house.
So to follow up from Zach, mentioning the current housing market, that's why these ready to hit the ground running. First, we're going to look at 2-year employment history. Now, this is not a hard set cutoff, but it is what the underwriters are looking for. They want to see a good 2-year history at least. Not a lot of gaps in employment, not jumping around from job to job. They're going to want to see that, if you have changed jobs, it was for in the same field or for betterment of yourself. Because what they're looking for in this point is income security. They want to make sure that you have a steady flow of income that they can predict for the future. Next, we're going to pull your credit report right away just to make sure that your scores qualify. It's going to be a tri-merge report. Now, this is different than the soft pull that you may have heard of, apps such as Credit Karma or the credit scores you'll get from a credit card on their applications. Those are soft pulls. They don't affect your credit. They are a great tool to see what is out there on your credit. However, they're going to be different scores than what your hard pull is. When we do a hard pull, we pull from all 3 credit bureaus and more information is taken into account. Your qualifying credit score, your representative credit score, will be your middle score. Now, with multiple borrowers, they're going to go off the lowest middle score to get you qualified. We're going to ask for 2 years of W-2s, and this is just to verify income required on all loans. We're going to request 2 months of your credit union and bank statements. What we're going to look for there is to make sure that you have funds for down payment, closing costs. We're going to make sure that there hasn't been any, I guess, large deposits lately, that the funds have been seasoned for at least 60 days. When we say seasoned, we want to see those funds that have been sitting in your account for at least 60 days. Now, there are exceptions and things that come up that you would work with your loan officer. Part of what Zach mentioned, the consultative approach or consultative approach, we're going to review everything. We're going to look at those credit scores. We're going to look at your credit report. We're going to go over it with you. Even if currently we can't get you qualified, we're going to help you understand what we should do to get you to get qualified. And that's the benefit of working with a credit union. Now, the last thing is going to be your ratios. So different loan programs have different guidelines for ratios. And when we're talking about ratios, we're talking about debt to income ratio and your housing ratio. So your debt to income ratio is going to be all of the debts that show up on your credit report. We're going to add those together, your monthly payments, and divide by your gross monthly income. Now, we need that ratio on almost all loan programs to be under 50%. Now, some of them require under 45 and some of them under 43. But when you're working with your loan officer, they will help walk you through that, or Zach and I will help walk you through that. We'll make sure that you understand that. The housing ratio is going to be your forecasted mortgage payment with taxes and insurance divided by your gross your gross income. And we're going to want that to be under 30%. So, and it depends on the application, how strong. It's like putting feathers on a scale. If you have some strong attributes to your application and maybe there's some other weaker ones, they'll balance each other out, but we'll definitely work with you to help figure that out. One thing I want to point out when it comes to the debt to income ratio, we're only looking at debts that are on your credit report. We're not going to look at your gas bill, your electric bill, maybe you're currently renting, or your cell phone bill. Those are not included in your debt to income ratio. And I'll kick it over to Zach, let him talk about the 2-year employment history if he was going to add.
Just something to add on the 2-year employment history. So you don't necessarily, like Rob referenced, you don't have to necessarily be in the same job for 2 years. You could have changed jobs, as long as it makes sense for the job change, right? So if you took more money, it worked better with your schedule, if you had a child, right, a childbirth, and you needed to change something that was more workable with the new addition, anything like that. So I just want to reiterate, you don't have to be at the same job for 2 years. One of the things to be careful, though, if changing jobs is a lot of times most employers will put you on a probationary period, right? So it may be 30 days, it may be 60 days, it may be 90 days, but we cannot close the loan while your employment's in that probationary period. You have to be out of that probationary period and working, doesn't necessarily have to be full-time either, but you have to be working your normal schedule and out of that probationary period. So just something I wanted to mention on that and make sure you're aware that it doesn't have to be, same place for 2 years. And so I'm going to jump into the difference we talked about on the steps to buying a home. You'll need a pre-qualification or pre-approval letter. So realistically, they're kind of the same thing, but the pre-approval is a step beyond, right? So your pre-qualification letter or pre-qualification is going to be based on the information you put into, or the information you had on your application. So it means we've ran credit, we have your general income information, we have your general asset information, but none of it's been verified, right? We just have the information, but we haven't actually verified it. So a step above that is going to be your pre-approval. So pre-approval means we pull credit, we've run the application, we've run it through an automated underwriting system and got accept eligible findings. And then also with the pre-approval, that means we verified the assets and we verified the income, which was what Rob was referring to. We have your W-2s, we have your pay stubs, we've seen the bank statements, and we know that based on the information, that the actual documentation that we have in hand, that you shouldn't run into any issues, right? That's going to be a more solidified letter, and we're going to have more confidence in your letter that things are going to go okay in the process. So most real estate professionals right now, because of the competitive nature of the market, most realtors really want to see that pre-approval or pre-qualification letter. I'd say more so right now, the pre-approval letter. And the reason being is they want to know that you've taken the first step in getting that loan, right? They want to know that you've already talked to a loan officer, and that when you go to see a house, you have the true potential to buy that house. So especially with the pandemic and with sellers being skittish on people coming to the house, whether it be pandemic related or just the competitive nature of the market and how many offers they're getting, they're going to be very selective of who they let see the house. So you're really going to want to have that pre-approval letter in hand, or that pre-qualification in hand, prior to even trying to look at a house, because most agents right now are going to tell you, if you don't have it, I'm not showing it to you. And so because they feel like it may be a potential waste of their time, right? So we don't want that, and that's where the consultative approach comes in, right? We talk to your agent, we talk to you, you talk to LAFCU, we know everything's good to go, and that we can get you, that you're going to be good moving forward. So yeah, so it's really an important thing to have those ready to go to get your offer accepted. So again, pre-qualification, kind of your basic. Pre-approval is a more in-depth review of the application. And Rob, there you go.
You looked at a house at this point, you found the one that you want. Next step is to submit an offer. Work with your real estate agent, you'll submit the offer, you get that purchase agreement signed. You're going to want to get that over to your loan officer as soon as possible. The faster we have that signed purchase agreement in our hand, the quicker we can get your loan moving forward and get that appraisal ordered. With a competitive market, everybody wants that appraisal ordered as soon as possible. The market is pretty busy right now, so appraisals can take a little bit longer to get them back. So the sooner we have that, the better it'll be. Sometimes we run into where the real estate agent thought the borrower was going to send, or the borrower thought the real estate agent was going to send. So we just ask that the borrower reach out and let the loan officer know once they have that signed purchase agreement. Now, once we have that, we're going to send you over your initial disclosures. In these initial disclosures, it'll have your loan estimate, which will break down your loan in terms of closing costs, prepaids, your monthly payment, what estimated taxes and insurance will be. Your initial disclosure, even though we try to get it as accurate as possible, it's still an estimate because we haven't gotten specific information back yet from the title company in relation to taxes or your homeowner's insurance quote, which we'll jump into that in a little bit too. Also in that initial disclosure is going to be your home loan toolkit. Now, there won't be anything to sign in this, but it does have a lot of great information, and we highly recommend just thumbing through it and seeing if there's anything in there that you feel like reading, and it could help you understand the process a lot better. Now we're going to require your income documents. And I know at this point we probably already got your pay stubs and your bank statements, but if you've been searching for a home for a while, they may be outdated. So we just like to give you a heads up that we'll be asking for updated pay stubs and bank statements. The other hand, if you bank with LAFCU, we can reach out to a loan officer right here in the branch and get those statements for you, just to make one less thing for you to do. But just be aware that, you know, we will request those to be updated. That's usually the number one condition we get from underwriting is updated pay stubs and bank statements. And we'll go over what conditions are in a few. Now, after you've signed your initial disclosures, we've ordered your appraisal, we've ordered your title commitment. You have a choice whether or not you want to get a home inspection. And what a home inspection is a licensed inspector will go into the home you're purchasing, look all the nooks and crannies, and give you a report afterwards that will lay out anything that they feel may need to be addressed, or if everything is great and good to go. Now, this isn't required, but we do highly suggest it because, you know, you're making a large commitment when it comes to a home purchase, and we just want to make sure that that home is going to be right for you, and you're not going to move in and get straddled with a bunch of debts, maybe having to replace a furnace or a new roof. So we do highly recommend that. And you would just work with your real estate agent, and they usually have a home inspector that they'll suggest that does a great job. So we'll order your appraisal. While we're waiting for that appraisal to come in, we'll send your loan into processing review. And what will happen is a processor on our team will look over your loan documents and reach out to see if there's anything needed or any clarification. And then they'll also introduce themselves. We are always copied on those interactions. So if you ever have a question that maybe the processor isn't answering, you can always reach out to your loan officer and they will take care of that. So once the processing is done, the title commitment's back, the appraisal's back, we submit that loan into underwriting. This step is the most important step, as the underwriter is going to go through all of your documents with a fine-tooth comb just to make sure that everything meets the regulations and guidelines. During this process, they may give some conditions. And what conditions are is, for example, that I used earlier, like we need some updated pay stubs. Or the underwriter may say, you know, their employment switched. Can we get a letter of explanation if the, you know, why? So be on the lookout because the loan officer will ask for conditions. The sooner you can get those back to us or satisfied, the sooner we can get this loan closed for you. And we're always happy to help explain any condition or if we can do anything to help assist in getting that condition taken care of. Once those conditions are taken care of, the underwriter is going to say, you know what, this loan is clear to close. At that point, everybody's happy. We reach out to your real estate agent. We let you know. We coordinate the closing with the sellers, the buyers, the realtor, the title office. So we all get this done at the same time. I will kick it over to Zach.
Yeah. So yeah, of course, closing is everyone's favorite thing, right? But we're going to kind of go into the different loan programs. There's several different ones that you can kind of choose from, and there's some that may suit you better than others. So we'll just kind of go run down what they are, you know, what's available, and then we'll go into them in more detail. So the main loan program that you see out there, the one you hear about the most, is your conventional loans. A conventional loan means basically that it's sellable to the investor market, meaning Fannie, Freddie, Sallie Mae. There's several of them, but Fannie and Freddie are probably the most popular and probably hold about 85% of the loans out there. But so that's your conventional loan program. That's typically the one that you'll see realtors kind of ask for or want the most. And the reason being is it's the most simple process. There's no special requirements other than the general guidelines. So the condition of the home, for example, doesn't have to be quite the same as it does with some of the other programs and stuff like that. So we're going to go into more detail here. But so we have conventional loans. Then you have your jumbo. Jumbo is where the loan amount exceeds conventional guidelines. You have an FHA loan, which is a government-sponsored loan through the Federal Housing Administration. Rural development, which is through the U.S. Department of Agriculture, and they call it RD loan or rural development loan. Then you have your VA loan, which is geared toward veterans and those who qualify for veteran benefits. And then we're going to talk about the Michigan State Housing Development Authority, or you'll hear it often called MSHDA because that's a mouthful, right? But which MSHDA is not really a loan program. It's a down payment assistance program that helps contribute funds towards your down payment and closing costs. And I'll let Rob kind of jump into more in depth on the conventional loans here.
Sure. So to follow up, Zach, he mentioned conventional being the preferred loan product of real estate agents. And the reason for that is it's more streamlined. They tend to go through quicker and smoother. Now, we don't want to discourage you from any other loan programs because they all are great. And it's just the conventional is generally, just going off the name conventional. It's generally more streamlined. There are several different year terms you can choose: a 10-year, a 15, 20, and a 30-year fixed. Conventional loans, the rates are always fixed. The difference between a 10 and a 30 are going to be your interest rate's going to be lower on a 10, but your payment's going to be a lot higher. Where a 30-year, you're going to have a lot lower and manageable payment, but your interest rate's going to be slightly higher. It's not going to be, maybe we're talking 0.75 to a point, but it all depends on the market during that time. So with a conventional loan, you can borrow up to 97% of the purchase price of the home or appraised value. So that's only 3% you would have to come up with for a down payment. For example, a $100,000 purchase price, you would need $3,000 for your down payment. So with a conventional, you can also do a cash out refinance. You must own the home for at least 1 year to do cash out, but you can borrow up to 80% of the value or appraised value of the home. You can do a rate and term refinance, and you can do this at any stage. Say you've only owned the home for 2-3 months, as long as we can show that we're getting you a better rate or changing the terms of your loan, that's a benefit to you. You can do this at any point, and you can borrow up to 95% to pay off your current mortgage of your appraised value. Next, to discuss private mortgage insurance, what you may have heard called as PMI. With conventional, you do have to carry PMI only until you have 78% loan to value. Now, it'll drop off automatically. You just will see it not in your payment anymore once you hit that 78%. What you can do is you can look at your amortization chart after you close your loan and kind of go to the spot where you're at the 78% and expect that to be gone. So that's a great thing because, to be honest with you, PMI does not help the lender at all. Does not help the borrower at all. So it is an insurance product that you will pay for monthly, but it will have no benefit for you. What it does is it protects the lender. And that's just so we can manage risks. It's a requirement. And it is basically, if anything, God forbid, happens and the mortgage has to come back, the private mortgage insurance will make up the difference in anything lost. With a conventional loan, there's also a no funding fee. Now, as we get into the other products, you're going to hear about the funding fee. and what that is. But with a conventional, there is no funding fee. So it's, I mean, like I said before, it's streamlined. It's, it's the conventional loan. So I'll let Zach take it over.
Yeah. Yeah. So we talked earlier at jumbo loans, kind of inherently in the name, right, are larger loans that don't meet those conventional standards in terms of loan limits. So conventional loan limits are going to have a cap of $548,250, right? So you see that jumbo loan starts at $548,251. So anything from that number up to 1.5 million is going to be part of that jumbo loan package. Now, LAFCU's jumbo loan honestly is way better than the rest I've seen out there. So they'll offer you the same terms in terms of conventional financing, right? 10, 15, 20, and 30-year fixed rates. They'll allow, what makes this such a good program is they'll allow up to 97% of the purchase price or appraised value, right? So that's typically unheard of on jumbo loans. Most jumbo loans require 20% down, 25% down. So to finance up to 97% loan to value is really good. So I've worked for other lenders in my past, and I'll just tell you that we've never come anywhere close to that. So it'll also carry the private mortgage insurance, that you'll see. Now, private mortgage insurance, just a quick note on that. That's only required if you're putting less than 80% down. Anytime you put more than 80% down or 80% or more down, you are 20% or more down, or you're at 80% loan to value, you will not be required to carry private mortgage insurance. So something to note there. If you put 20% down, you're not going to be required to have private mortgage insurance. And even nicer and more generous with LAFCU's jumbo loan is there's no funding fee, just like the conventional loan. So they really have structured it to mirror that conventional loan, but at much higher loan amounts, right? So we realize that doesn't apply to every borrower out there. Not everyone's going to be buying a $500,000 home, understood. But in terms of this program, truly, really great program. So jumbo loans are the jumbo loan through LAFCU is phenomenal. So, and then I know Rob's going to be covering the next loan product out here, but and you'll start to see that funding fee come in.
With FHA, it's another product similar to conventional, but there's going to be a few different requirements outside of the conventional, and it's a great product. Don't be discouraged if your loan officer says, hey, unfortunately we couldn't get you qualified for conventional, but we got you qualified for an FHA. There's nothing wrong with an FHA loan. It's a great loan product. It helps a lot of first-time home buyers and second, third, fourth-time home buyers get into their home they want. There's two different terms. You can do a 15 or a 30-year fix with an FHA loan. You can borrow up to 96.5% loan to value. So instead of 3%, you have to put 3.5 as the down payment. You can do a cash out refinance with an FHA up to 85% loan to value. Rate and term refinance up to 97.75% loan to value. So 0.75 higher than, 2.75 higher than a conventional loan. You will have to carry PMI insurance, though, with an FHA loan for the life of the loan. It doesn't automatically drop off. However, the PMI insurance is going to be at a lower rate, so the monthly payment will be a little bit lower than what you would get with PMI insurance on a conventional loan. You can always refinance down the road, and if you refinance over into a conventional, you would get rid of that PMI insurance. So it's not going to follow you everywhere, but as long as you're paying on that mortgage, you will have to carry primary mortgage insurance. Now, there's a one-time funding fee with FHA, and that's going to be 1.75% of your loan. Now, you're not required to come to the table with that. That will be rolled into your loan amount. So FHA, what they do is this funding fee is collected from all the borrowers that borrow through FHA. And it goes back into the program, basically. Now it exists because, you know, FHA offers certain things that, you know, other loans don't. They take more risks. The guidelines are to get a borrower qualified are a little less stringent. Now, I mean, say you are a first-time home buyer, you just started credit. You have credit scores, but maybe you don't have a lot of credit history. FHA will, you know, a lot of times will take that chance where conventional will say, you know, they don't have the credit history. We're unable to see that pattern of, you know, great credit or, you know, good credit or, you know, them trying to pay. So FHA has a lot of benefits that conventional doesn't. When it comes to the home, sometimes FHA has a little more stringent on the condition of the home, but that shouldn't make most people scared because they're you know, they want to make sure that you're moving into a good home. So they're gonna require a few more things, and your loan officer, when you're working with them, they can go through all that with you. Real estate agents are very versed in FHA or conventional, what they're required with the home. So when they're showing you a home and you have that pre-approval or pre-qualification for an FHA loan, they're going to show you homes that qualify for the FHA.
Absolutely. Yeah. So another loan product out there, a little less common than most, and you'll hear why here. But it's called a rural development loan. So the rural development loan is a loan product offered through the U.S. Department of Agriculture, right? And kind of, again, these names kind of fit the product, right? It exists to kind of expand and entice people to move to a rural area and kind of build up that area. So a rural development loan, they only allow a 30-year fixed. One of the biggest benefits is they don't require a down payment. So you can purchase up to 100% loan to value. And you'll see down lower here that there's a one-time funding fee of 1%. That can also be rolled into the loan on a rural development loan. So technically, you can finance up to 101% of your purchase price, but that's including that funding fee in there. So you have to be in a rural area. Well, what does that mean? So there is an eligibility map that you can go to the USDA website. So I don't have the exact website here, but if you have any questions, I can look it up for you. But and you can Google search USDA property eligibility map, and it will take you right there. And it'll literally let you put in an address, a zip code, whatever it may be, and see if that's eligible for that property. So kind of like the FHA loan, or exactly like the FHA loan, I should say, is you're going to have that PMI or that mortgage insurance for the life of the loan. Now, just so you know, we call it private mortgage insurance, and that's the most common name. FHA calls it a upfront mortgage insurance premium. On rural development, they call it a funding fee or a guarantee fee. So they're all called different names, but they all serve the same purpose. So a lot of times you'll hear, if you hear PMI, that's generally speaking the same thing. So, and you'll see it across the board. Not only do they have geographic requirements on the rural development, meaning it has to meet those the property eligibility, but there's also an income limit. You cannot make too much money. It is kind of geared towards specific borrowers. I can't tell you exactly what that income cutoff is going to be because it's going to depend on a few things. One of the main things is going to be the county. So there's county limits. whether you're in Ingham or if you're in Calhoun or Kalamazoo County or Macomb County, wherever it may be, there's going to be different income limits depending on that county. And then also with that, there's going to be it's going to depend on how many income earners you have in the household. So if you have 3 people over the age of 18 that all earn income, even though they may not be related or married, but all are planning on living in that home, we have to count income from all 3 of those people. So if your cousin Bob is going to be living with you and he's 18 and he's earning money, we have to count that into the income eligibility. So it's a nuanced program, but it is a really cool program, and I've know a lot of people have used it, and it can be a very good program. But the main things that are going to come up are those geographic and income requirements. I know. There you go.
Another loan program that we see a lot, and I'm sure everyone has heard of it, is the Veterans Affairs Loan, or VA loan. For all the veterans, or sometimes their family members, if you have a certificate, you can qualify for this loan, and it's an absolutely wonderful loan. It has a 15 or 30-year fixed term. You can borrow up to 100% of the appraised value of that home or the purchase price. You can do a cash out refinance up to 100% of the appraised value of your home. There is no PMI. There's no mortgage insurance. This is a federally backed loan, so that it's an absolutely great loan. There is a one-time funding fee, which is 2.3% for first time, for borrowers using it for their first time, and 3.6% for those who have already used their eligibility and are buying again another home. The VA funding fee can be waived if you are 100% disabled. You can have that VA funding fee waived, and that's usually provided, that information, and also the other information that what you qualify for is going to be provided on your eligibility certificate that you're going to get from your VA liaison. Absolutely great loan, and it's truly beneficial. So if you do qualify, you want to make sure you ask your loan officer about that to see if they can get that, because we offer it, and we would love to help you get that.
Yeah, and I'll jump in. So he was referring to the VA funding fees there. So that's going to depend on down payment. Okay, and so if you're a first time buyer or first time user of the VA loan, I shouldn't say first time buyer, first time user of the VA program, and you're putting less than 5% down, you're going to be at that 2.3% funding fee. Now, as you can see, it tiers up. So if you go from 5 to 10%, just under 10%, that VA funding fee is going to change to 1.65%. And then if you go 10% or more, it drops down to the 1.4%. On second time use, the only difference is going to be in that less than 5% down bracket. It's going to jump up to 3.6%. And again, you're going to get a certificate. You would have a certificate of eligibility that would kind of spell out some of this for us and kind of give us an idea of what you're looking at. But it's a really, really VA program is just an awesome program. I'm a veteran myself, so I really dig the VA program, and it's a really, really great program to use. So if you qualify, highly recommend the VA program, and there's some other benefits too with VA that we like. If you're possibly, you could get exempt from property taxes. So really, really great stuff for veterans.
As Zach mentioned earlier, the MSHDA down payment assistance program, not every lender offers them, and we have experts here that can help you get through it. I originate them all the time, and I absolutely love this program. What it does is allows first-time home buyers to get in a home with minimum money down. It can provide up to $7,500 or $10,000 towards your down payment and closing costs without any fee or cost to you. What it does is it's technically a second lien on your home, but it never has to be repaid until you sell the home or you do a cash out refinance. But until then, you don't have to make any payments on it. You don't have to repay it at all. It's just there. You still have to make your mortgage payment, but the down payment assistance is in the background until you sell or refinance to do cash out. The buyer will have to still contribute at least 1% of the purchase price. And generally this is probably going to be covered most of the time in your earnest money deposit that you submit when you get that purchase agreement, and then your appraisal deposit. A lot of times that it's going to take up that 1%, and then you really don't have to worry, it's going to be covered. If the closing costs or the down payment is higher and it comes to more than $7,500, you will have to come up with that difference. So just things to consider, and your loan officer will go over that with you and work with you so that you know what's expected, what you're going to need cash out of pocket. As before, it is a piggyback. You can do a conventional loan, an FHA, or a rural development loan, and use this down payment assistance program. It's specific to Michigan, which is amazing. Not a lot of states have a program like this. And it really helps first-time home buyers, get into that first home, without being, I've just used my entire savings to put a down payment on this home. Now I don't have money to update anything in the house, or like we mentioned earlier, furnace goes out or anything happens. Sometimes it's nice to just have a little bit of extra cash after you move into a home, and this down payment assistance can help with that. One thing to mention, it does come with a few different requirements than the other loans. A couple of examples are we're going to have to show 12 months of on-time rental payments. We'll have to show 3 years of W-2s as opposed to 2, and 3 years of federal tax returns as opposed to 2. There is an income limit, and as well as any adult living in the household will have to be on the mortgage application. Outside of that, it's truly a great program, and I highly suggest, if you qualify, to take advantage of it. And we are absolutely ready to help you. And if you reach out, we can provide you with more information on the MSHDA program.
Absolutely. So now that we kind of gone over a lot of the programs here, and those are really the main programs out there, but we're going to kind of go over the what to do and what not to do, right? So I know we've kind of probably hit on some of these a couple times, but again, meeting with your mortgage loan officer earlier. The earlier we're involved in the process, meaning the earlier we get that purchase agreement, the earlier we kind of understand what's going on, that's going to make everything faster. And when I say everything, I mean we're going to get the appraisal ordered sooner, we're going to get to processing sooner, we're going to get to underwriting sooner, and ultimately get to closing faster too, right? So very, very important that we get involved as quickly as possible, so that we can really kind of start the train rolling, so to speak. Having your documents organized, right? We covered what documents we're going to need. So W-2s, pay stubs. Now, not everyone may be a W-2 employed. Maybe you collect Social Security. Maybe you're a veteran and you get VA benefits. So replace W-2s with maybe 1099s, or if you're self-employed, we may need tax returns, right? But just know we're going to need those tax documents, whether they be 1099s, W-2s, or actual your actual tax return. So getting all those things together so that when we do meet, we have it, it's ready to go. That means processing is going to be reaching out to you less. That means underwriting is going to be reaching out to you less. When we have everything up front, it's really, really helpful and going to just benefit everyone in the process. One of the things that we're kind of always seems to kind of linger a lot of times, and I'm sure Rob can attest to this, is we're waiting on homeowners insurance quotes, right? So
Right.
you got to get us a homeowner if you're purchasing a home or if you're refinancing, but mainly if you're purchasing a home, we need that insurance quote. That's going to give us an idea because that's going to affect your cash to close. 1 year of your homeowner's insurance premium is going to be due at closing. It's going to affect your payment, right? If we're escrowing for your taxes and insurance, we need to know that homeowner's insurance is going to tell us how much to collect for each month, right? So, and that's going to be built into your payment. So it's really important that we get that quote up front because we could be quoting you, $1,200 a year and you get it for $600 a year and we're over quoting you on everything, or the opposite could happen. We could quote you $1,200 and it's $1,800. And if we don't know that, then we're just using what we have our best knowledge, kind of use a generalized, idea what it could be. And then as Rob mentioned earlier as well, is you're going to get that once we have the purchase agreement, we enter that into the application. That's going to initiate your initial disclosure package. That typically is going to take anywhere from 24 to 72 hours to send to you. It is an electronic document package. It comes from, typically you're going to see it from documailer@solex.com, which is just an e-sign document. You use the last 4 of your SOCH and the property zip code and you log in and it'll have all your disclosures there. You review them. And once you get to the bottom, you have to review all those disclosures first. But once you get to the bottom, you click start. It'll take you through and you sign it. And the nice thing is it sends it as soon as it's signed, it sends it right back to us. But we can't order appraisal. We can't order title work. Your file doesn't go into processing until we have those initial disclosures signed. So it's really important that, you don't take your time and a week later, like, oh yeah, I think I was supposed to sign that, because that means we just lost a week of processing time. That probably means we're going to close a week later than we would have. So signing those initial disclosures up front is really going to be important. And this will kind of go into what not to do for Rob here.
So now that we know what to do, not to be the killjoy, but this is what not to do. These are the highlighted important things that we see a lot in this industry. One is don't apply for new credit after you get pre-qualified, pre-approved, or even have a purchase agreement. Don't apply for don't go out and buy a brand new car, or don't get a credit card. I mean, you can do these things, but talk to your loan officer first so that they can assess what this may do to your approval status, because that's going to affect your debt to income ratio. A lot of times when there's a hard pull on your credit report, you could drop down up to 5 points. We've seen them. It depends on how many points the credit bureaus will tag you for that, but we just want to make sure that if you're on that crest for between a 3.25 and a 3.5, that your credit score doesn't drop 2 points when we go to repull it, and now we have to increase your interest rate. Just one example, but there are many. Just work with your loan officer to make sure that before you apply for any new credit.
I got about 100 examples.
Right. Now, not to discourage you from applying with other lenders, because once we pull your credit for your mortgage application, you do have 30 days to shop around for mortgage purposes. So that don't let that discourage you. But anytime after, don't apply for new credit. Don't change jobs. This is a big one. We see it a lot. We have a lot of stories about somebody changing a job week before closing, or retiring or quitting and not letting their loan officer know. And then we do a employment verification. So your loan officer is going to find out, the underwriter is going to find out. It may change your approval to a denial. It definitely is going to slow the process up, because now the underwriter has to go back and relook at the file, look at the income docs. We have to redo a lot of things in the application. So don't change jobs unless you absolutely have to. And like all of these, just talk to your loan officer before you if you really have to, talk to your loan officer first, so that they're prepared and they can help guide you through it. Another one is sell items for cash. One of the things we have to look for is bank statements, and with the USA Patriot Act, in order to prevent money laundering, they require us to we have to paper trail every large deposit in your bank account. So if you sell something for cash, then you go and deposit, say $5,000 into your account. Now the underwriter is going to say, hey, where's this $5,000 coming from? We're going to want to see, transaction. We want to see the check. We're going to see the canceled check, the sales slip. It's going to cause a lot more paperwork for you, for us. And at the end of the day, it could be detrimental to your loan. So and again, just like the other things, if it's something you need to do, speak with your loan officer, speak with Zach or I and let us know what's going on, and we can kind of assess it and see if this, if it's anything that's going to affect your mortgage application. To parlay into that, it's, the same thing. Don't manipulate money. Don't say you have $5,000 in your account with AB Credit Union and you want to move it over to C and D Credit Union. Don't pull it out and then put it in. Just keep your funds where they're at for the time being. That way we can show they're seasoned. We can show where they were at, where they came from. It just makes the process a lot smoother. We ask that you try not to schedule movers or contractors before your official closing date. And the reason is we just don't want more stress on you, or if we don't want you to lose out on any deposits or anything, because with the mortgage business, there are so many different moving parts. A lot of times we have every intention to close on or before, or your closing date, but say something comes up on title, or the appraiser noted something that we have to send the appraiser back out. It could postpone that closing date. So if you're on a tight timeline with movers and contractors or anything like that, we just ask that you try not to do that as much as possible. Just save yourself stress and money.
All right. Do we have any questions?
Yes. Looks like we'll open up for questions.
I'm looking in the chat. I saw someone ask if you have to pay out of pocket for home inspections. Typically, and I see someone answer, so thank you to the participants for answering that. But typically, yes, you do have to pay for a home inspection. Now that is optional, right? But highly recommended. You don't necessarily have to use like a licensed home inspector, though. Again, we would recommend it. But typically, yes, that would be something that you pay out of pocket.
Yeah, and just to add, we generally see them. If I ballpark the cost of them, $150 anywhere, to $250. It really depends on the size of the property, but they're relatively cheap, I would say, compared to what it could save you in the long run.
Absolutely. And I'll let the moderators take over here. But I also saw what relationship would qualify you for a VA loan. It's going to depend on the veteran and that situation and what their where their benefit status is. So that's really going to depend on the certificate of eligibility. I would say have whoever that relationship is with, talk to a VA consultant at the VA, and they would be able to tell you if you're eligible or not. Basically, all we need is that certificate of eligibility that states that you're qualified for those benefits. So I would talk to the VA specialist and at your local VA and ask them about that.
So Zach, another question I've seen in here, what about student loans being so high for your ratio and debt?
Student loans, yes.
Yeah. So yeah, student loans, they will affect your debt to income ratio. Currently, as we all know, I mean, I have student loans myself, unfortunately. So as we all know, it's very real. We see them in 90% of the applications. So right now, most of them are in deferment from COVID. With that, we are allowed to use your prior income-driven student loan repayment program from before COVID deferment. So say you had worked out a payment program with your student loan provider for $100 per month. We can use that. We'll just need to get the documentation from you. Now, if you didn't have a payment prior to that, or your monthly payment is stating it's zero because it was in deferment, we would have to use 1% of your 1% of your balance as your monthly payment. Or if we go Freddie Mac, Freddie Mac and FHA is 0.5%. So that's what we would use in case. So, I mean, if you didn't have an income-driven payment plan prior to COVID and you're currently in deferment and you're thinking about for a mortgage, you can reach out to your student loan provider and discuss an income-driven payment plan for you after the COVID deferment. And we could also use that as well to qualify you.
If you don't mind, I'll just add a quick note.
Sure.
If you're in an income repayment plan and it's $0, we can use $0, but we just have to document, that payment. So if you're in an income driven repayment plan and it says, hey, you don't have to pay anything through this plan, then we can use that as your monthly payment.
Perfect. And it looks like I see one more question here, guys, about what relationship would qualify you for the VA loan. For example, father, son, what would be required?
Oh, yeah, I thought I mentioned that, but maybe not. Yeah, it would just depend on that veteran's benefits and who the beneficiaries, what benefits are going to carry through to the beneficiaries. So VA consultant at your local VA would be, and I think there's actually some other, there's other offices within, maybe your county that could answer that as well. But I would contact the VA consultant or the VA and just, if that person's deceased, I would contact the VA. If the person's still around and you want to see about the benefits, talk to the veteran and see what they can come up with. But a lot of times those benefits do carry down, but it just kind of depends on their disability amount, how much time they served. There's going to be different factors that play into that.
Perfect.
Any other questions?
That is great. Thank you again, everybody, for taking your time to join this webinar. I believe we do have your email addresses, and we would be happy to send out the recording of this webinar if you guys had any follow-up questions. We also have our information to share with you guys as well as far as contact information. So reply to that e-blast that should be coming out tomorrow, thanking you for attending. And if you have any questions, don't hesitate to reach out to Rob Kennedy or Zach Carlson, and we would absolutely be delighted to help you with your home search. So let us know, and we will be here to serve you.
Yes, thank you all for your time.
Yes.
We appreciate it.
Thank you.
Yeah, thank you, everyone.
Have a good evening.
See ya.
Thank you.